Okay, so this is the fifth and last part for chapter 6 of church financial management. So, use and management of that, and then we'll also discuss the 5 C's of credit. Okay, so earlier we already mentioned the debt philosophy. So, considerations before you decide to acquire a debt, and then have the factors to consider before you do, and then the purpose for which you must acquire a debt. Okay, you can't use it for operations, you can't use it to pay off another loan, and as much as possible, you only acquire one to improve the facilities or to build up the facilities of the organization. Okay. Um, there's what they call this. There's a word of caution here. Very useful in specific circumstances, but can cause lethal injury if not handled properly. Okay. Again, it could ruin the church's reputation if the church fails to pay off the loan, and then the creditor or the lender demands the whole amount. Would the church be able to pay it off or not? So that would be kind of, a scandal, or it's not a good situation to be in. Okay, it could cause problems. It could question the integrity of the church management. It could question the beliefs of the church, not just the church management, but all the other members as well. If the leadership is not honoring their obligations, they are unable to pay off the debt. So it might, you know, trickle down, and the members might also be questioned. Okay. So in any way, with regards to debt management of debt, as much as possible, if you can raise the money, or if you can set aside the money from the regular collections during the year, then it would be best to pay off as much as you can. Okay, pay off the debt as much as you are able, right? In a way that would also help you in, less problems. Um, you would not uh, be concerned about the interest rates or the penalties that you may incur if the church is unable to pay. So again, it's a matter of being able to set aside funds first to settle the debt, and then make do with the rest for the operations of the church. But of course, the best case scenario would be to ensure you have enough for the debt, and then to ensure you have enough for the operations, for the activities of the church. Okay, so you have that. Working capital loans. Okay, working capital, when we say working capital, this is the operations. Okay, again, you don't want to borrow money for the working capital. Working capital is the current assets of the company. Okay, the current assets would be the cash, inventories, receivables. But for churches, it would mostly be the cash. Okay. And then we have the so-called net working capital. Net working capital is current assets minus current liabilities. So the available cash after you pay off the current liabilities. It's like before you spend on the operations, you must settle or pay off the current debts yet, okay, or the current obligations, okay. So again, for churches that would be cash minus the debt to suppliers or whatnot, current liabilities. So that would be the net working capital. That's why it's called working capital operations. Okay. And again, you don't want to borrow for working capital. Furniture and equipment financing. So this might be good, but since this is only furniture and equipment, short term, maybe 1 year, 2 years. Okay. That should be the period for this one. Maybe up to 3 years. Okay. And then mortgage financing, normally this is for building or vehicle transportation, could be 5 years or more. Okay. This is the most acceptable reason for borrowing money. Okay, and then five C's of credit in church mortgage financing considerations. This is on the point of view of the financial institution or the creditor or the lender. Okay, normally they would check the following: character of the person or the management of the organization, the governing body, the board of trustees, if they have integrity, if in their personal history they do pay off their loans on time and diligently. So that's one consideration, one thing they look at. Cash flow, so stable history of positive cash flows, which clearly supports in a well-documented manner the church's ability to honor the proposed debt obligation. So on the part of the church, they can also assess themselves to check if they think they would be able to borrow money from a financial institution. Okay, because if they don't, they call it, have solid proof of these five C's, their application for a loan might be declined. Okay, so they also have to assess themselves if they think the lender or the creditor would lend them the money. Okay, in regular finance we have character, capability. Okay, what's the other one? Character, capacity, and collateral. There's another one I don't remember. Okay, essentially capacity. These two, cash flow and cash reserves, this would fall under capacity. Okay, your check if the church would have enough cash to eventually pay off, and then cash reserves if they do have enough cash that which they may use to pay off the loans in case they're unable to regularly uh, what do you call it regularly collect enough money to pay off the loans. And then collateral, since churches would normally borrow money for facilities, building vehicles, then they can use them as collateral, those assets. Okay, the danger there is that if the church is unable to pay off the debt, the property would be, what they call it, forfeited in the favor of the financial institution or the creditor. Okay, they would take possession of it. The church may not be able to use them anymore. Okay, so there's a danger there, and that might affect the operations of the church. And then you have the contingency plan. What would the church do in case they don't have the cash to pay off the obligations? What are they planning to do? Would they consider negotiating with a financial institution for financial restructuring of the loan, offering other collaterals, or maybe extending the term, asking for a reduction in interest or penalties, things like that. Okay. Or would they be able to borrow from, let's say, a member, or would the congregation be able to raise enough money for to pay off the debt or things like that? Okay. And then others, what do you call it? Same information about the character, cash flow. Can read this can read this portion of the book. Okay. And then you have the conditions, terms and conditions when you are availing of loan. So have to be very careful. Make sure that you would be able to, what do you call this? Let's say interest rates, 5%, 8%, 12%. Do you think your church can afford paying that much interest, and then the penalties, and then how long can you pay it off? Within 5 years, or do you need more time, 10 years maybe? So those are considerations that you might want to take into account as well. Okay. Another term for terms and conditions or options and terms are covenants, loan covenants. And then there are other terms here, but not really applicable in the Philippines. Although it's available in the Philippines, ordinary organizations don't normally engage in, hedging. Loan covenants, we do have loan covenants. Okay, let's discuss this one. Financial covenants. Certain financial institutions would require organizations to, aside from paying regularly the monthly payments, they would also ask the organization to, let's say, you should maintain a certain amount of cash uh, in your bank account. So let's say every month you should have 50,000. If it goes lower than 50,000, then that would be considered a default. You'd have to pay us the whole amount. Okay? Certain financial covenants. Again, you might find it, unfair or unrealistic, but certain loan agreements do have them. Okay, because they want to be assured that every month the organization would have enough money to pay off their monthly installment. Okay, so that's why they require maintaining a level of cash. Okay, minimum cash reserves covenant, debt service coverage. They don't want the total debt service payments to exceed a certain amount. Okay, because again, it's not that they're concerned about sorry, it's not that they're concerned about hindering the regular activities of the church, but it's more about ensuring the church would have enough to pay off their loans, including theirs. Okay, so there is that. Non-financial covenants, other requirements, but these are non-financial requirement that the church submit audited financial statements annually. Requirement that the church submit initially prepared interim financial reports, either monthly or quarterly. What else? Maintain its entire banking relationship with the lending bank. Stipulation that the church will not incur any new debt without the lender's approval, okay, etc. So these are other considerations, right? You may want to read this part, okay? It's good. Non-financial covenants. And then importance of engaging legal counsel to make sure that you understand all the provisions in a loan agreement before you, sign a loan agreement. Okay, you don't want to enter into a loan agreement not knowing, the interest rates, the monthly payment, how much is the total interest for the whole period. You have to consider all those things. Okay. And then tax exempt financing for church operated private schools. In a way, again, we do have tax exemptions for educational institutions and churches. They have separate clauses, so which is why normally they are also registered separately. And sometimes, what do you call this? Well, here in the Philippines, there's not much restriction on, the debt. There's not much correlation between the debt that the organization would incur um, in connection to their tax exemption status. Okay, so as long as it's being used for the purpose of the church or the school, then it's fine, right? So that's it for chapter 6 of what's it? Managing liquidity and financial condition. Okay, we'll move on with chapter 7, maintaining sound internal controls, right? So that's that.